Those were Bloomberg TV guests earlier weighing in on some of the risks markets are facing, a lot of them fiscal. That brings us to our question of the day. Do you play political risk? Here now is Kathryn Rooney Vera. She's chief market strategist at StoneX Financial. And Kathryn, obviously there's a number of political risks we could talk about. The threat of a government shutdown, just the fiscal trajectory of the United States, conflicts in the Middle East and Ukraine. My question to you, though, is does any of it really matter?
It's hard to play political risk, and I wouldn't advise attempting to. But what I am concerned about on a structural basis is, of course, what your clips mentioned before, which is fiscal responsibility. And the fact is that the U.S. Economy is not growing at a rate commensurate with a $1 trillion fiscal deficit. Add to that the $2 trillion QT that the Fed is currently engaged in, increasing borrowing needs for an economy that's growing minimally, and I think next year has a very elevated risk of recession, which only aggravates those needs. When you look at interest costs as a percentage of GDP, Kaylee, it's pretty concerning when you look at that trend. Over the past about 1 year, you've seen interest costs as a percentage of GDP go from 2.4 to 3.6%. That's very significant, especially, and this is probably what concerns me the most, with the Fed not being, that price-insensitive buyer. You have a lot of price-sensitive buyers that are caring about where treasuries are trading.
Yes, and it's this question of what happens with the Fed still doing QT, what happens with the BOJ maybe tweaking policy, who's left to buy bonds. So, Kathryn, is that how this manifests itself, just in continued pressure, continued higher yields, especially on the long end of the curve?
It's a structural issue, but for the time being, and I think Mike McKee alluded to this, it's not something that I think is going to be a debt crisis immediately, because the fact still remains there is no market as deep and as liquid as the U.S. Treasury market for those countries with those enormous current account surpluses, China, Russia, Saudi Arabia, in which to invest. So China is trying to diversify into gold, but the fact is that probably over the course of the next couple of years, the U.S. is going to remain the main player, especially when the U.S. dollar remains the sovereign reserve currency of the world. So in the meantime, if political risks such as government shutdown actually causes yields to go higher, equities to go lower, then we could talk about playing political risk. But I think we've all learned this lesson before. We've seen this story play out multiple times, several times a year in some cases, that government shutdown is something very temporary in its market impact.
Yeah, well, markets, at least for the time being, seem much more concerned with the monetary policy path than the fiscal one, because that's the more immediate threat or concern, if you will, that we're dealing with. And on the monetary policy path, there's a lot of conflicting research out there that Danny and I have been discussing. You have Morgan Stanley calling for 300 basis points of cuts from the Federal Reserve between now and the end of 2025. Goldman sees 175 between now and the end of 2025. Then you have UBS out saying 275 basis points of cuts by the end of next year, by the end of 2024. Kathryn, which side of those three do you think is perhaps most accurate?
Soft landing is inconsistent with multiple hundreds of basis points in cuts next year. I don't think those two can mutually survive. So when we're talking about 200 and 300 basis points within a soft landing or a no landing, makes no sense to me whatsoever, unless we're talking about nominal rates remaining so high, immaculate disinflation continuing its miraculous move lower. I'm just not a believer in that. So I think that something has to break for the Fed to cut in such an enormous way. I think something will break, and that's what's required to get inflation, if the Fed has a strict interpretation of its dual mandate, to that 2% target. So yes, I do think there's a good chance that the Fed cuts rates next year, but it's not going to be pretty. So, we get this idea that equity markets are going to rise because bond yields move lower. Well, not necessarily the case, Kaylee, when bonds are moving lower because the economy is moving into contraction. Valuations are currently not strong enough, not healthy enough to withstand a drop in earnings expectations going into next year, which I think is going to be the case. I think companies are going to have a tough time maintaining margin expansion in an environment of still high labor costs, still high energy costs, and still high interest rate costs. Real rates are very high, so I think we're probably more likely than not going to get employment shedding next year, and that's going to take a downward impact, or have a downward impact on consumption.
Right, but in the meantime, equities seem to not care. Sure, they're a little bit weaker today, but as this bond market's been whipsawed around, as the front end of the curve goes above 507%, equities have been higher for 9 out of the past 10 sessions. What is it going to take to actually care, to click in this idea that if we're pricing in rate cuts, it's bad for the equity market?
Right. I think we're going to have to actually see a recession, Danny, because when you look at things, consumer confidence is still remarkably robust. Retail sales is pretty resilient. So until we see a rollover in confidence, which is a leading indicator for consumption, think about it. Consumer discretionary, you're not going to change your habits of consumption if you still have a job or if you're getting wage increases. Even if they're not equivalent or higher than inflation, you're still going to maintain your habits of consumption. What fundamentally could change that, I think, is threats to your job security. So until we see some rollover more meaningful than what we've seen in the labor market, that's when I think that the market is going to realize that equities are going to have a tough time sustaining themselves in a stagflationary or recessionary environment next year. That's why I prefer fixed income over equities going into next year. And the fact is, equity risk premium in the US, in Europe, maybe only in Japan, but US and Europe just looks honestly atrocious. So I don't see why you would want to take risk at current levels, adding to positions that have done so well year to date, particularly the ones that historically underperform in recessionary or stagflationary environments. And that's tech, that's discretionary, that's communication services.
Well, to your point about you preferring fixed income to equities going into next year, how much risk, though, do you see in that call to be longer in duration in the bond market, considering we have seen such volatility in the bond market that it seems like it's just very unclear what direction things are going to go, and we're moving this number of basis points with this degree of frequency pretty much every week?
Right, that's a good point. I think you still want to stay in short duration paper. It's still yielding very juicy levels, equal to or in some cases better than the earnings yield on the S&P 500. But certainly, I think in this fourth quarter, especially as we go into recession or look like we're going to, it's going to be time to find some duration in those higher quality investment grade names. I'm not talking about high yield. In fact, I would be recommending buying CDS on high yield. We haven't seen the credit cycle fully develop yet. I don't think that this is a whole new reality. What we've experienced, Kylie, from my perspective, is an aberration. It's not an entirely new economic scenario. So I think that recession and the credit cycle has been postponed. It's not been altogether avoided.
Yeah, you and UBS saying we don't see why things would be different this time. Kathryn, I'm afraid that's all we have time for. Thanks so much for joining us. Kathryn Rooney Vera, Chief Market Strategist at StoneX Financial. Now, still ahead, Apple plans an ambitious iOS update as it looks to compete in the AI market. We're going to have the details in the startup next for you. This is Bloomberg.
We're working on networks that are